Financial planning and security can sometimes be seen as a moving target. The rules change constantly, and you need guidance to stay ahead of the market moves. This is the Lebenthal Report with Michael Hartzman and Dominick Tavella. We'll break down the news, trends, and overall direction of the markets, telling you what may be coming next, investment opportunities, and what to avoid. Now, here are your hosts, Dominick Tavella and Michael Hartzman.
All right, I'm Michael Hartzman. Today is Tuesday, October 26, 2021. And on a rainy Tuesday evening, I'm on with my partner, as always, Dominick Tavella. Dominick, how are you?
Good evening, Mike. No complaints. And as you alluded, I think a good part of the country has gotten slammed pretty hard. We were no exception, but thank God everybody's safe, everybody's healthy, and we can look to brighter days, hopefully.
Yeah, I think we can get part two tonight. I think tonight the wind starts, so that'll be terrific. With all the trees we have on Long Island.
Yeah, we're not used to this kind of severe weather. The Midwest is, I think, but we get our fair share, and I guess this is one of them, and hopefully we get through this one too.
I'm sure we will. And speaking of getting through things, the market on October 4th, the S&P was at 42.86. And a mere 3 weeks later, it's at 45.74. Check my notes. So in 3 weeks, Dom, the market is up 6.7%. And we always sound like broken records, but it's like, well, never mind. Everything's fine.
You know, what amazes me, Mike, and I know we've spoken about this in the past, but the headlines during that time, some very, very well-known, very well-established Wall Street economists, Wall Street equity strategists, we're talking about 20% corrections. Now we got to about a 6-7% number, and we called for that. We talked a lot about that in our own podcast and our own conversation with clients, but some very well-respected people were talking about 20% corrections. And can you imagine if you followed their advice?
No, you can't imagine. And look, eventually, Dominick, we're going to get that 20% correction again. And I don't know if we're necessarily overdue. As long as the fundamentals stay in place and there's not any major surprises, the sell-offs that we have are healthy. But you know, there really has to be a catalyst for a 20% correction. We're not going to have one just because there's a few negative headlines.
And Michael, to your point, I think, again, you're spot on. And we get the question all the time, hasn't the market gone too high? Isn't it too expensive? And it has to come down. It comes down because usually there's a reason, sometimes a very good reason. And we could talk about what happened a year ago when the world economy got shut down because of COVID, or in 2008 when we had failures in the banking system, or God forbid, 9/11 when we had two towers right here in New York get destroyed and thousands of people pass away. So usually an event comes along to shock the economy, shock the markets, and creates it. Those are very hard to predict. But the cyclical nature that we're going through in the economy, hey, we get enough warnings that we can see these coming.
And look, there's still things to worry about. We still have supply chain shortages. We still have labor shortages. We still have inflation worries, but what the market focuses on frequently is good earnings. And because if portfolio managers, like the guest we have on tonight, John Eade, if a portfolio managers are going to put money to work, it has to be with a company that is generating profit and has strong fundamental numbers behind it. And we're still seeing that.
So Mike, and we use the analogy tonight of the weather, and we often use that analogy when we're speaking to our own clients, right? I know you do. I love using that analogy. Mm-hmm. Hey, you follow the weather report. I'm not saying we're going to get run over by the tornado or the hurricane, but we look at inflation. We look at where interest rates are. We look at what GDP is going to be. We look at consumer confidence. We look at the weather report, the leading economic indicators, to got to get a sense of where we are in the economic cycle. And then we use analysts and experts like our next guest that are going to look at the company level. Is this company going to earn what we think it's going to earn? Are they going to sell enough goods? Are their profits going to grow? And that's where we make decisions at the company level. So the global level in terms of economic growth, the company level in terms of sectors and specific companies. Hopefully we make better decisions over the long run. And people are like, how did you know? Look at the weather. It tells you. You get enough of a hint.
It does. It does. It was 70 degrees on Friday and it was miserable today. And you know what? It's going to be 70 degrees again and it'll be miserable again one day. So you just have to look at the pattern, not what happens on a day-to-day basis.
And it's tough, right, Mike? When I just hinted at it, when you get the bobbleheads on TV and they're talking about 20% corrections, we had a real doozy over the weekend. A very well-known entrepreneur, billionaire, talked about a stagflation economy where inflation would be at over 20%. I mean, that scares a lot of people. I'm not saying it can't happen, but that scares an awful lot of people.
It does, and also creates a headline. It's the headline that gets the attention. You know, as I always say, comes to the media, if it bleeds, it leads, and that's a good headline. So tonight's guest is John Eade, who's the president of Argus Research. He's been on before. He runs a great research company that we've gotten to know over the last year and a half. We have a pleasant announcement to make as it relates to Argus, Dom, and you know, unless they want to add to that, we will be right back right after the break.
Yeah, we'll make the announcement with him on camera with us.
Absolutely. So we'll be right back right after the break.
Are you paying federal taxes on your cash? I work hard for my money that I keep in cash. And for the life of me, I can't imagine why anyone would want to pay federal taxes on their cash. That's why I keep my cash in the Lebenthal Ultra Short Tax-Free Income Fund, symbol LETAX, le tax.
Rates on cash are already so low, why pay federal taxes on the interest your cash earns? Remember, it's not what you earn, it's what you keep. The Lebenthal Ultra Short Tax-Free Income Fund, LETAX, may help you earn more on the cash you've worked hard for and keep more after-tax dollars in your pocket. Find out more about the fund by speaking with a Lebenthal Global Advisors private wealth advisor or its sponsor at dcmadvisors.com.
For your hard-earned cash, why pay the tax when there's the tax?
Lebenthal Ultra Short Tax-Free Income Fund. It's not what you make, it's what you keep. Before investing, you should carefully consider the fund's investment objectives, risks, charges, and expenses. This and other information is in the prospectus, a copy of which may be obtained by calling 800-441-7031. Please read the prospectus carefully before you invest. Investing involves risk, including loss of principal. There is no guarantee that this or any investing strategy will be successful. An investor should consider the investment objectives, risks, charges, and expenses of the fund carefully before investing. The fund is distributed by Ultimus Fund Distributors, LLC, member FINRA. The fund may invest in municipal securities, the interest on which may be subject to federal alternative minimum tax. After the fund buys a security, the IRS may determine that a bond issued as tax-exempt should in fact be taxable. There is no affiliation between DCM Advisors, LLC and Ultimus Fund Distributors, LLC. DCM Advisors and Ultimus Fund Distributors are not affiliated with Lebenthal Financial Services, Inc. or Lebenthal Global Advisors, LLC.
All right, I'm Michael Hartzman, back with Dominick Tavella, and our guest this evening is John Eade, president of Argus Research. John, good to see you again. How are you?
I'm terrific, Michael. Thanks for having me on the show tonight.
Welcome aboard, John. Thrilled to have you here, and I'm very excited to get right into this discussion with you.
Great. Me too, Dom.
So let's just jump right into it. As I alluded to in the open, the market's had a nice rebound, up a little bit more than 6% in probably the last week. The GDP number is coming out on Thursday, gross domestic product, which is really the all-in number that measures the economy, the growth of the economy, basically the health of the economy. Expectations come down a lot since the summer. Do you see a number that could move the market, John, one way or the other on Thursday in terms of a disappointment or a surprise?
Well, yeah, I think Michael, the number that might move the market, and to put this into context, where we were over the summer, we had 6% plus GDP growth in the first quarter, and a little bit higher, it's like 6.7% GDP growth in the second quarter. Those are the best numbers in the past 40 years.
Mhm.
So we're going to come down from those numbers, and we've gotten a couple of indicators to that, with the non-farm payrolls reports recently have been a lot weaker than we were seeing in June and July, when the economy was starting to reopen before the Delta variant hit. So I think anything in the 2.5% to 4.5% range is going to be okay, right? Our economy was growing at about 2% over the years heading into the pandemic. There still is stimulus money working its way through the economy. There are a lot of jobs out there. The COVID cases are declining, so it's not going to be that 6%. Our forecast is right around 4%. But the number I'm worried about, Michael, would be something of sub 1%, particularly if there's another data point in the GDP report that comes out, and that's the GDP implicit price deflator, which is the GDP measure of inflation. And if that comes out hot, like 6 or 7%, and the overall economy is growing at 1%, well, that's going to change a lot of expectations for investors. So that's something I'd be worried about, but that's not what we're forecasting at Argus. We think it's going to be slower than the first half, but still a real good number, right around 4%.
Just to follow up to that, if the number is sub 1%, we're inevitably going to hear the R word, right? People are going to start talking about a recession on the horizon. And
I know.
And that can move the market for sure, negatively.
Right. It was only a couple of months ago that the economists called all clear that the recession had actually ended.
Mhm.
And we had such a weird recession this time. Usually they're 1 or 2 quarters. This one was 2 months. It was March and April, and by May the recession was over. But it took them a year to tell us that the recession was over. So not a whole lot of transparency with that process either.
Mhm.
So, John, you actually brought up one of the issues. So it looks like COVID is rolling over, and it's not going to further shut down the economy. So that's a positive. But clearly, the backlog, the pipeline problems have kept companies from being able to sell products and consumers being able to buy them. So how much of that has really held back economic growth? Does that affect GDP in the short run? And when do you think it opens up? When do you think this pipeline opens up?
So you see that impact in the inventory numbers in the GDP. People talk about consumer spending, they talk about capital investment, they talk about exports and imports and government spending. But whether inventories are growing or declining also is a big contributor to those GDP trends. And for the past couple of quarters, as these supply chain issues have emerged, inventories have been declining. They can't build the inventories anymore because they can't, get the goods. They can't get the materials. We're probably going to see another quarter of declining inventories. And you don't usually get more than a couple quarters in a row when companies want to rebuild their inventories. So once we do get on the other side of this supply chain issue, I think inventory building is going to be a big contributor to rebounding GDP growth.
So is that the logic behind this week where some of the tech companies have had really good earnings? Because obviously a tech company is not going to be as sensitive to the supply chain shortage that we've been experiencing.
Oh, for sure. And the technology we're using to host this show, remains very much in demand. All kinds of new technologies in the biotech area, in designing new drugs and producing them. So that has been a consistently growing segment of the economy. It's a segment that they just started to break out a few years ago called intellectual property products, and it's software and it's R&D, and even when the pandemic hit and consumer spending fell off a cliff, we still saw a lot of investments into intellectual property products. So that's a big driver of the economy right now.
So, John, we saw, and I think this is what worries me the most. We saw UPS's earnings, and the top line growth was very good, but a big component of that is they raised prices. So I guess it's good news that people are willing to pay those higher prices. It's good for the company. But when they're raising prices because the input cost, the inflation number, cost of fuel and other materials is so much higher, is that in the end a good sign for top line growth, or maybe a leading indicator of problems we're going to have down the road?
Yeah, we'll have to see, Dom. FedEx is in that same business, and FedEx ran into problems with volume growth about a month ago, but they weren't able to manage the labor expenses. And so they actually had an earnings decline. But UPS was able to keep those labor expenses under control and beat expectations and raise the guidance. So, definitely a good outlook for the UPS stock. And we saw management teams at a lot of the rail companies execute the same strategies. Their volume was down at CSX, at UNP, but they kept the costs under control, improved their margins, delivered good earnings growth, and those stocks have recovered. I think we're going to have these supply chain issues, certainly here into this fourth quarter, which is the big holiday shopping season. There's going to be enormous demand on these shippers. I think FedEx said they were planning on hiring, I think it was 50,000 employees to handle the peak load when that comes up. But again, I think I lean more on the side of the Federal Reserve, where these are transitory issues, and if the transition is not 2 quarters, it's not 2 decades either, right? I do think there's another side that we get to, and the pricing pressures decline. And one of the things that we look for, one of the statistics we monitor is, at Argus, is inflation. And there are 18 or 19 different ways of measuring inflation, everything from the CPI to the PCE to the PPI. But there are these surveys of investors' expectations for inflation. And for this 1 year out, the survey is for 5% expectations. 3 years, it's 3%. And by the time you look out 5 years, those expectations are back down to 2%. So I think we're going to be heading back to normal. And I think that's what consumers expect right now.
So you don't think that consumers are still addicted to the punch bowl and are really so used to these low interest rates, and that's what's also piling so much money into the stock market?
Yeah, those low rates have really provided a lift to stocks, and you go all the way back to 2009, 2010, when Bernanke brought the interest rate to zero and started to buy back bonds. We've been in an era of low rates since then, and that has been good for stocks. But there are other, I think, global factors that have contributed and are likely to continue to keep interest rates low. And one is the global source of employees and workers, workforce, right? We're able to shift around the world to find lower cost production costs, for example. And then in a lot of the very wealthy nations that have their own issues with their economies, and they have negative interest rates. So you see these global wealth funds, they want to have fixed income exposure. They don't want to invest in something that's going to cost them money at negative interest rates. So they've moved their money into US treasuries. And there's been, that kind of extraordinary demand for US treasuries, which has helped keep our interest rates low, despite these numbers. Typically you expect to see maybe a 200 basis point gap between the 10-year yield and the inflation rate. And if core inflation is running at 4% now, then you'd expect the 10-year to be 6%, and it's 1.6%, right? So there are other factors going on for sure.
Yeah, but just a quick follow-up to your point, when it gets to 1.6%, as Dom likes to use the expression, all the talking heads start squawking about inflation. But in context, it's only 1.6%.
Right. And I think that's those expectations, right? The expectations are that the Federal Reserve has inflation at least somewhat under control, has tools to manage it, just as they've had these tools to manage these two incredible financial crises, right? The Fed hasn't been perfect, but I do think they've done a good job of, pulling the economy out of a recession and keeping it on a growth track.
John, I would agree with you. I'm not a big negative guy on the Fed and the job they've done. I think I agree with you I think overall they've done a pretty good job not having a crystal ball. On the other hand, they are the leading buyer of these treasuries. And that's one of the major reasons these interest rates have stayed really low. When they slow that buying process down, the quantitative easing, which they might do later this year, we should see bond prices and interest rates go up bond prices go down, interest rates go up pretty substantially, I would think.
That could be next week, Dom, right? They've got their last meeting of the year. I think it's their last meeting next Tuesday and next Wednesday. And they've, they started telegraphing back in August at Jackson Hole that they were probably going to be starting to unwind later this year and likely to be wrapped up with the unwinding by the middle of next year, like by next July. So they've been pretty transparent, and I think next week we'll see if they're true to their word. What's interesting is they're not going to get that non-farm payrolls report next Friday. They're going to have to, make this judgment without that latest data point on the economy. However, I do think that non-farm payrolls report next Friday is going to be higher and better than the last two that we've seen. And I really anticipate the Fed to say, okay, we're going to start putting on the brakes on our bond buying, probably in December, announce that in November.
And look, I think you would agree with this point that they might err on the side and actually slow it down a little slower than they said, rather than accelerate it. I think they'll make a mistake, and the bond buying program will go slower, not faster than they said.
Right. And not only have they been buying treasury bonds, but they've been buying mortgage-backed bonds too. And that's helped keep mortgage interest rates low. And the housing sector has been a big driver of the U.S. economic recovery, as people, moved out of their apartments, wanted backyards, space between their neighbors. And lately, though, prices have risen so high, I think up 20% year over year for the past 2 months, according to Case Shiller, that we're starting to see existing home sales slow and building permits slow. So that housing market is cooling off, and the Fed really doesn't want to see that happen.
But higher mortgage rates would do exactly that, right?
Yep, exactly. Would contribute to that.
Sorry about that, Mike.
No worries. I like listening too. But do you agree with the Fed? If they end the tapering program, do you think it's time?
Yeah, I do. I know that it could be a challenge for stocks, but I do think that there is a lot of momentum in the economy, even if we get a low number here in this third quarter. We've talked about the inventory issue. We still have workers on the sidelines who can come back into the workforce. We have more jobs available than we have workers now. So that unemployment rate, which is, I think, down to 4.8% now, was at what, 14, 15% back last March, was 3.5% before the pandemic hit. I think when it hits 4%, that's when the Fed probably starts to lift that federal funds target rate for the first time. But that's a lot more jobs coming, and that's going to be a positive driver for the economy as well.
And John, let's not forget, we have Washington now that's negotiating on this infrastructure bill and the social whatever bill that could potentially be adding another $3-4 trillion of additional cash flow / bonfire money onto the pile here.
Yep. And they seem to be in a mood to compromise now and actually get something done. So, this is not a midterm election year. Remember, this time last year, we were talking about the presidential election and all the fallout from that. But next year is a midterm election. The Democrats are going to want, some positive steps they've taken to show. So I think we're getting close to a compromise deal here, and it might not be 4.5 trillion, but I bet it's close to 2 trillion coming into a $23 trillion economy. So that's almost 10% of stimulus right there.
2 trillion on the social bill, another 1.5 on the infrastructure bill.
Right.
I think that passes as well.
Yep. So we're out of time on this segment, but just the other headline as it relates to the infrastructure bill is it looks like the corporate tax rate hike is also off the table, which Wall Street's going to love if corporate taxes are not going to go up. So we could talk about them more on the other side, but we will be right back right after this quick break.
Financial planning and security can sometimes be seen as a moving target. The rules change constantly, and you need guidance to stay ahead of the market moves. This is the Lebenthal Report with Michael Hartzman and Dominick Tavella. We'll break down the news, trends, and overall direction of the markets. Now, back to the Lebenthal Report.
All right, I'm Michael Hartzman, back with Dominick Tavella, and our guest this evening, John Eade, the president of Argus Research. And Dom, I'm just going to throw it right over to you because I know we have an exciting announcement to make as it relates to our relationship with Argus and John's company.
Sure. So I'm really excited to announce, and John's been a guest in the past, but this time it's a very special guest because the Lebenthal Growth Portfolio, separately managed account where you're owning the individual stocks, is being managed today by Argus and John as the growth portfolio manager. So Argus has a tremendous track record in this space, and we did a lot of homework and talked to a lot of people in the industry, and very pleased to come to an agreement with Argus and John in managing this portfolio on behalf of our clients. So John, welcome aboard. You're really one of the team members now.
Well, thank you, Dominick, and we're grateful for this opportunity. As you mentioned, we have an 85-year history of serving the financial community. We signed up as a registered investment advisor. They call that the 1940 Act in 1940. And we've been managing money for clients since the 1950s. So we've got a lot of experience. We've got a great team. We've got a very disciplined process, and we're grateful for the opportunity to serve you and your clients. Thank you so much.
I think what was most exciting for me is you guys do most of your research in-house. So you're really digging into these companies and you're looking at the balance sheets and earnings and all that funky stuff to determine this is a good quality company we want to own in our portfolios. And by the way, these other companies don't meet our criteria and they don't make the cut. So maybe you could talk a little bit about your research.
Sure. And you're right. That's our name, or Argus Research, right? That's our kind of core business. And I've got a team of 20 analysts based here in New York. They've got a lot of experience. They've got on average 19 years of street experience and 12 years of experience working at Argus. So they know our systems, and our systems are designed to serve our clients. So they know what our clients are looking for. And they're well versed in reviewing the companies under their coverage. They typically cover 25, 30 companies in like the utility sector or the healthcare sector or banks. We've got analysts covering all of the different sectors. We have what we call a 6-point system that we use to rate stocks, buy, hold, and sell. And those 6 points are, a company's growth. Are its earnings growing? Are its revenues growing? Are its expenses growing? So forth. We look at financial strength. You mentioned financial strength. So we're going to pull through a company's balance sheet and look at its debt levels, its fixed cost coverage, earnings quality, profitability. And these are all, calculations that our analysts can make, and black boxes can make them too. But part of our process is qualitative. And so the third factor is management. We make an assessment on the quality of the management. We meet with the management teams. We participate in conference calls. We host managements with clients. So we get to know the management teams. We measure them up to the goals that they set. We review ESG criteria, and management is a third factor. We look at the risks that a company faces. We look at the industry it's in, where it's positioned in the industry. And then the sixth factor is valuation. And we're going to run several different valuation calculations on these stocks. And then after my analysts do all this work, I really rely on their expertise and judgment to weight the factors the way they think is most practical for their industry. For example, my tech analyst is going to weight growth more than he's going to weight financial strength. And my utility analyst is really concerned about dividend safety, and he or she is going to be really focused on that financial strength. So it's a process that we use and we've developed over the years, and we train our analysts on it. But the analysts run it well because they've got the experience on the street and with us and our clients.
So John, talk a little bit about your sell discipline as well. What's the criteria there? How often, do you look to prune the portfolio, and just what criteria goes into when you guys decide, either this is not working out or we've made a nice profit and we're going to take the money and run?
Okay. Yeah. So the selling is important, right? And sometimes it's the most difficult thing to do. Our clients tend to be buy and hold clients. So we're not recommending, scores of portfolio changes in a year. Our turnover is probably going to be in the 25 to 30% range. The growth stock portfolio that we're working on with you has 30 stocks.
Mm-hmm.
And so maybe 6 or 8 of them might change in a year. And they would change, perhaps the company didn't meet the earnings expectations that we had set. And so, we aren't expecting that growth as much anymore. And a lot of times we get a signal on that growth from a company's dividend growth. We like to see companies that are increasing their dividends every year. And if they're increasing their dividends at like a 10% pace each year, then that's a message they're sending to the market that they're pretty confident on their outlook. So if there's a change in dividend policy, that might be something that we consider. We haven't focused so much, Michael, on valuation, right? Not to replace a stock in a portfolio. Typically, our portfolios start out as equally weighted. So if we have 30 stocks, they're each around 3%. And then to manage that stock specific risk, if we see a stock move like above 5%, we may pare a little bit off the top of it and reinvest in some of the other stocks. But one of the great stocks that we've had in this portfolio has been NVIDIA, the leader in artificial intelligence. Mm-hmm. And if we had sold that out 3 or 4 years ago, we would have missed out on a lot of these gains. So our analysts are understanding what's going on in the industries they're following. And if they're confident that the company is well positioned in this industry, we'll live with a bit of a high valuation to a degree. But it's really more the faltering earnings growth that will concern us.
Thank you.
So John, I definitely want to focus on our growth portfolio, but the truth is, because I've witnessed it already firsthand, you do research in the entire universe pretty much, right? So the joy I get is I get to come to you and go, it's not even one of your stocks, and go, hey, give me your opinion on this one. We have a client that just brought into one of our portfolios, or do you have any research on this other company? So you've been an invaluable tool for us already, even though it may not be something right in our portfolio.
Well, I appreciate that, Dom. And our analysts are people, right? They pick up the phones, they call people back. They listen to your questions. If they don't know off the top of their head, they'll research it and get that answer back to you. And there aren't many independent shops like us anymore. A lot of the independent research are quantitative models that collect factors from financial documents everywhere. But it's hard to ask a model a question and get that answer.
And the other value that you bring to us, John, is, Dominick and I interviewed a lot of different portfolio managers. And to your point, a lot of them are just gigantic. And you get what you get and you don't get upset. But in your particular case, if we bring you a portfolio and say, hey, your clients own this stock forever or really loves this stock, or there's this huge capital gain, could you work around it? And you were so flexible in saying, yeah, we'll build a portfolio around this position if that's the criteria that you've laid out, which is really invaluable to us, because at Lebenthal, that's what we kind of pride ourselves on, is being flexible and not being dogmatic, and having partners who feel the same way is really helpful to us.
You got to listen to the client, Michael, right? If we really hated the stock, we would tell you that,
and we would pass that along, right?
But at the end of the day, we're working for the client, and we've got to meet their needs, which may involve tax situations or other factors that we're not completely up to speed on ourselves.
And the other part of that is I had 2 ladies who inherited money from their grandfather. And for me to go in there and just say, hey, grandpa did a great job, but I want to sell everything and we're going to start all over. They want to hold on to some of grandpa's stocks. So,
right.
We held on to a portion of it and worked around that. And that's the flexibility that we employ, and that we're grateful you employ that as well.
Well, terrific. Glad to hear that. And that certainly is how we've operated.
You already alluded to this, but many of the industry players are so large, and we just took on a very large client because he was looking at a competitor of ours, and their answer was, well, we're selling everything on day one, everything. And these were very substantial accounts. Like, no, they don't fit our criteria, they don't fit our model, and we're going to plug and play in our game. And we both, all 3 of us, have been in this game for a long time. It can't be an all or none scenario, right? It's not in the client's, typically not in the client's best interest to do that.
No, not with the typical clients we work with. With some of the larger institutional clients who, it's just a button to push to wipe out the portfolio, benchmark it to the S&P 500, fiddle around till you get the losses and come out on the other side. But that's not our typical client.
So John, just to circle back to what you actually do for a living, and that's the stock picker and looking at sector rotation, what sectors are you looking favorably at right now as we head towards the end of the year and the beginning of the new year already?
So that is something we do, Michael. We cover 500 stocks in all of the different industries. And our director of research, Jim Keller, who I'll look forward to introducing you to, makes sector recommendations once a quarter for the clients. So the sectors he likes are a blend of secular sectors. Like he likes the tech sector, and he's liked it for 8 years, and it's been a good call for 8 years. Healthcare is another secular sector that he's favoring. With interest rates starting to head higher, he has moved financial services to an overweight mark, and he has also moved materials to overweight. With rates rising and inflation rising, a lot of times you see aluminum take off or copper take off. So those are the ones. The healthcare, the technology are more secular, where our economy is going. And the financial services and materials really more reflect some of the top-down calls that we're making. And he's not very big right now on the consumer sectors. The consumer discretionary has gotten kind of expensive with stocks like Tesla and Amazon.com dominating. And consumer staples just aren't bringing much growth. And as we saw from Kimberly Clark the other day, they're facing a lot of these supply chain constraints. So that's where he's a little lighter in the consumer areas.
Thanks.
So John, when people think of large cap growth, they come back to Google and Facebook and Netflix, right? And the growth space is so much larger than just those 5, 6, 7 tech stocks, right? And you mentioned some of the sectors. What are some names our clients would recognize that are good quality growth stocks? Okay, so in our growth portfolio, one of our big themes, Dom, is innovation. And we have 4 ideas on innovation: new companies with new products, companies that are first to new markets, companies that are disruptors, and companies that are also product and process perfectors, because you can get innovation in management. And let me give you some examples of those companies, okay? So in our the first to market area, we've got the real estate investment trust, American Tower, which is business is booming as 5G momentum accelerates. We've got the engine manufacturer, Cummins, which is in the lead for hydrogen power and a transition from carbon energy to clean energy. And then we've got S&P Global, which is the financial services firm and is the first to China to rate Chinese bonds. And China is going to be financing more and more from fixed income. So we were impressed there with S&P. In the disruptors, we've got the ones that we've talked about. We've got Alphabet, we've got Amazon. We also have BlackRock, which has disrupted the financial services industry with all of the passive investment. In new products, we've got a drug company, right? You get a lot of new products from drug companies. We've got Eli Lilly, we've got Intuitive Surgical. We also have the big generator company, Generac Holdings. It is a mid-cap company, but it has been a leader in generators now for 30 years. And then in the product and process perfectors, here's where we get some of the more mature companies, which give us a little bit of a value balance, like a Chevron, a low-cost producer in energy, or Target, which is the great retail company. So there's some names that are recognizable, some that might be a little bit surprising, but those are the kind of companies we're looking for as innovators in our growth portfolio.
John, Thank you for your time. And Dominic, you're an old pro at this. You saved the best question for last, because I'm sure our clients and listeners are busy writing down those names.
Well, they just have to
John,
buy the Lebenthal growth portfolio, Mike, and they get them all.
there you
And they
go.
get John managing it. So that's the perfect answer.
There you go. John, thank you very much for your time. I'm sure we'll see you down the road.
Love to have you back, John. Thank you.
Thanks, Mike. Thanks, Dominic.
We'll
Have a
be
nice
right
night.
back. When you're thinking about where to park your cash, for over 30 years in the business, I've been a fan of funds like the Lebenthal Ultra Short Tax-Free Income Fund. It's managed for cash and designed so the interest income you receive is free from federal taxes. And who doesn't love paying less taxes?
Mike, generating interest that's free from federal taxes is appealing, but I've been in this business for a long time, and people love the potential for more income on their hard-earned cash.
Sorry, Dom, but the beauty of the fund is paying less taxes on cash.
No, my friend, it's the potential for more income.
Less taxes.
More income.
Less taxes.
More income.
Less
For your
taxes.
cash,
More income.
ask your advisor
Less
about the Lebenthal
taxes.
More
Ultra
income.
Short Tax-Free Income
Telling you,
Fund,
less taxes.
or find out more at dcmadvisors.com.
Well, Dom, one thing I know we agree on, it's not what you earn.
It's what you keep.
Lebenthal Ultra Short Tax-Free Income Fund, symbol LETAX. LETAX. Before investing, you should carefully consider the fund's investment objectives, risks, charges, and expenses. This and other information is in the prospectus, a copy of which may be obtained by calling 800-441-7031. Please read the prospectus carefully before you invest. Investing involves risk, including loss of principal. There is no guarantee that this or any investing strategy will be successful. An investor should consider the investment objectives, risks, charges, and expenses of the fund carefully before investing. The fund is distributed by Ultimus Fund Distributors, LLC, member FINRA. The fund may invest in municipal securities, the interest on which may be subject to federal alternative minimum tax. After the fund buys a security, the IRS may determine that a bond issued as tax-exempt should in fact be taxable. There is no affiliation between DCM Advisors, LLC and Ultimus Fund Distributors, LLC. DCM Advisors and Ultimus Fund Distributors are not affiliated with Lebenthal Financial Services, Inc. or Lebenthal Global Advisors, LLC.
All right, I'm Michael Hartzman, back with Dominick Tavella. And Dom, we were talking on the break about the companies that John mentioned, and you wouldn't think, as you said, a target is a growth company, or more importantly, a disruptive company. And that's a word that's been bounced around now for almost 10 years. And disruptive companies clearly turn out to be industry leaders because they're doing something different in a sector that their competitors are not at that moment.
And look, Mike, the next 5 years are not going to look like the last 5 years. So you just can't go out and buy. I'm not saying Apple's not going to be a good company, or Google or Facebook or Netflix, right? But what are the next group of companies going to be over the next 5 to 10 years? And what we've seen, and again, we've mentioned all the time, you and I have been in the industry for over 30 years. What were the great companies 20 years ago are not the great companies today. And somebody needs to be ahead of the curve here, looking at this and rotating a portfolio. And I mentioned it also in the break. Where do we get our ideas from? How did we know? And it's experts like this, right? Some brilliant people that have been doing this for a long time.
Yeah. And to your point, sometimes I'll be watching an old TV show from the early 2000s, and, the people on the show have the old Nokia flip phone. What happened to Nokia? They're just, I know they're still around, but when was the last time you saw someone with a new Nokia phone? And 20 years ago, Dom, Apple phones didn't even exist.
Look, I give the example that if we go back to the .com era and you had a choice of picking, IBM or Apple, which stock would you own? And clearly, hands down, you would have picked IBM. Big Blue. This was the dominant company in the computer industry. This was bulletproof. You put your money, you went to sleep. And Apple, people forget, borderline bankrupt. I mean, literally borderline bankrupt. But if you had bought Apple, you'd be a multi-millionaire, billionaire today. And IBM, okay, but not the same kind of growth, right? So somebody's got to make these decisions daily, weekly, monthly, annually, and rotate a portfolio.
And another great story in that same vein, and Scott, my son, told me this story. about 20 years ago, a little company called Netflix went to Blockbuster and said, "Hey, we have this streaming company and would you like to purchase us?" And Blockbuster said, "No, we're good." I'm going to take a pass on that. How'd that work out?
Yeah, Mike, and I always bring this up because, John mentioned Amazon, but people forget Amazon was a bookseller
That's right.
online, right? They were competing with Barnes and Nobles. They were selling books, and look what it grew into. Talk about a classic growth company, right? So somebody's got to be out there looking for this stuff and keeping their eyes open and adding these little jewels in a portfolio and hopefully getting them to grow along with the quality of our portfolio.
Yep. So as we said, that definitely is the definition of disruptive technology. And Dom, we talked about the market having this rally, but there are some things coming out in the next week that we'll be able to talk about. The GDP number, as we said, is printing on Thursday, and John alluded to the Fed meeting next week. So I think we'll have a little bit more excitement one way or the other to bring to our clients in the next couple of days.
Yeah, look, volatility. It hasn't gone away. It's not going away. And then we usually always get a little pause after earnings season. So we have that on the horizon to look forward to and prepare for. So yeah, our job is never done, Mike.
It's never done. And sometimes you think, okay, we could take it easy because we're going to get the so-called Christmas rally. But if these supply chain problems don't clear themselves up and consumers can't buy stuff, then we may not get that Christmas rally either.
Mike, so I know we're running short on time, but one of the things in our industry you can count on is the American consumer. They represent 60, 70% of the economy. They will always spend, but if they can't find what they want to buy, will they? I think that's the largest unanswered question through the rest of the year.
Well, we will see, and we will pick it up down the road. And we are out of time, Dominic, and I will see you next week, my friend.
Have a great evening, Mike. Looking forward to next week's podcast.
Have a good night, everybody.
Thanks for tuning in to the Lebenthal Report.